Hi guys. Today we will analyze Shoe Carnival stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market, but recent evolutions are not positive. The short-term trend is neutral, while the long-term trend is still negative. We need to see a little more continued positive action to make this really interesting. Support levels are around $29 and $27.80. Strong support levels are around $20 and $15. Resistance levels are around $32.80 and $36.40. The next resistance level is around $40. In the last month the stock has been trading between $28.20 and $33.60. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 0.4 million. This is not a very liquid stock. The stock has been in a downward trend since November 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 7% per year, for last 5 years. We see that the average profit margin of the stock has been around 5% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 157% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Shoe Carnival Company: bad, average, and good. First scenario. Shoe Carnival will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 3%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $14. Second scenario. Shoe Carnival will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $23. Third scenario. Shoe Carnival will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $36. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.42. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Shoe Carnival, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 8. Again, I will use 3 different scenarios for Shoe Carnival Company: bad, average, and good. First scenario. Shoe Carnival will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 5. In this case, the fair value of the stock today would be $14. Second scenario. Shoe Carnival will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 7. In this case, the fair value of the stock today would be $23. Third scenario. Shoe Carnival will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 9. In this case, the fair value of the stock today would be $35. As you can see, today the stock is fairly valued, $30, if we expect the company's high performance in future. The fundamentals are good, and the stock is currently fairly valued. However, it's not a very liquid stock. Stocks with low liquidity may be difficult to sell. Even if you are sitting on unrealized gains on these stocks, it may not be possible to take the full profits, due to large bid-ask spreads. Generally speaking, there is no need to invest in low-volume stocks. Most investors are better off with ETFs, mutual funds, and large listed companies. However, if the stock drops to $20, I may consider buying it. Company's strengths. Shoe Carnival is an American retailer of family footwear. The company operates 377 stores in 35 states. Its brands include Crocs, Nike, Wolverine, Skechers, and New Balance. The main difference in Shoe Carnival stores is its concept. The Shoe Carnival concept is creating an urgency to buy through limited time promotions and the microphone. The mic person announces specials over the microphone. These specials include discount, product information, and fun specials which encourage customers to make a purchase. The company has a strong balance sheet, and it has enough cash to keep on acquiring companies, expand its organic store footprint, and reward shareholders through buybacks and dividend payments. The company has a return on assets of 19% and a profit margin of 12%. This is amongst the best returns in the industry. Its return on equity of 34% is in line with the rest of the industry. The company is debt-free. Risks. Supply chain constraints, including factory shutdowns, and port congestion. The company's performance is dependent on overall economic conditions, and soft consumer spending, and changing fashion trends could lead to lower than expected revenue and earnings. In addition, it depends on strong foot traffic at shopping malls. The company also faces intense competition, and its efforts to improve brand awareness and offer better merchandise could fail to achieve the expected results. Based on estimates for the next 5 years, the company will show a small growth in revenue and earnings per share. The revenue will grow by 6% on average per year. In the coming 5 years, the EPS will grow by only 2% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.